why is that important? So actually these arbitrage strategies, as we've defined them here now, are designed to be universally attractive for everyone in the market. Remember our discussion from last week, we talked about risk preferences, right? So the idea here is because they're free of risk, that means even if you're so scared that you want to hide below your desk for the whole day, you're so risk averse, you would still like to do arbitrage trades because they're free of risk, right? So risk preferences don't matter whether you like this strategy or not, because it's risk-free, you always like it. The next thing, it doesn't require capital. So again, it's universally attractive because it does not depend on whether you're a billionaire like Bill Gates or Warren Buffett and Jeff Bezos and so on. Everyone, even we in this room, should be able to do this if we don't have a lot of money on our bank accounts. Right? So we design the strategies to be universally attractive for everyone. And now the thing that we assume in the financial market is that once you stumble on such an arbitrage strategy, there are so many investors that are immediately jumping on them and immediately doing these trades. Right? So that's an important thing. What's the consequence of this happening? Right? Remember the example of the share price, 74 in Berlin and 75 in Frankfurt. Assume people figure out that's an arbitrage and want to do the trade. What happens? There's lots of demand. Yeah?
No, I just wanted to answer.
Yeah, sure, go ahead.
Yeah, so when the share price is low, everybody buys there, and in that city the share price will go up, and we should expect that in other cities should go low, because in other cities they are selling.
Yeah, so remember that whenever you have a transaction in the market, there needs to be buyer and a seller, right? So not everyone can buy, there must be the same amount of sellers. But the general idea is, I would rather use the word supply and demand instead of buying and selling. Right? So there's lots of demand in Berlin to buy the shares, and there's lots of supply in Frankfurt, and that would, the consequence is of course clear here, which is correct, that the prices should converge until the strategy is not feasible anymore. Right? So that is a key assumption that we're using in financial markets, is that basically if you observe the same thing trading at different prices, people would immediately figure out, okay, if it's an arbitrage, let me just do the trade immediately, and prices will converge quickly. And this is a common assumption, that we assume that the markets are then, as a consequence, free of arbitrage, and that means we can evoke the so-called law of one price, which is the pricing rule that we're going to use here, which basically means that the same shares, like Daimler, should have the same price everywhere if the market is free of arbitrage. If that shouldn't be the case, the market is immediately correcting it in a way such that the prices quickly converge. Now, the Daimler shares are, of course, an easy example, but I want to highlight that you can apply this in much more complicated contexts, like, for example, stock options or derivatives. And we're going to do this in this class quite often. Because the idea is that you actually don't have to have exactly the same thing, like Daimler share here in Berlin and in Frankfurt. You can also use other financial instruments that you have, slice and dice them, and put them together in a portfolio to recreate a certain stream of cash flows. Okay, suppose a stock option. A stock option is a little bit of a complicated contract, and we're going to study it later. But a stock option doesn't exist naturally. The idea is now find other contracts whose prices you can observe and recreate the cash flow of the stock option. Right? So, and the thing that we're going to do later in the class is we're going to figure out how many of the shares that are underlying the stock option you have to buy, and usually have to borrow money or invest money in a government bond or a money market account. Right? So you can observe the rates of the money market account, you can observe the share price, and this two pieces of information will be enough to price the option. Right? So we're putting that into a portfolio in a certain fashion such that the portfolio has the same cash flow as the option. And then by the law of one price, the price of the option has to be equal to the price of the portfolio. And this pricing principle is called replication or duplication. That's really the same thing. Right? So the strategy of replicating a cash flow must have the same cost as the cash flow itself. Right? So it's a very important principle. And if you want to work in an investment bank, that's what they're doing all day, basically. Derivatives don't magically appear somewhere. They're produced, basically. Like derivatives are, shares always exist because companies sell them. So they're in positive supply. But derivatives are not in positive supply, they're in zero net supply. for every buyer, you must find a seller. And the sellers are typically the investment banks. And they really call this the production of derivatives. They produce financial instruments. And the first thing that if you go to your manager in the investment bank, she will ask you, okay, you have this fancy product that you want to sell. How do you hedge it? How do you replicate it? Because usually the investment bank doesn't want to have a counter position. They want to bet on rising or falling markets. They want to earn money independent of that. Right? So they immediately ask you, what's your replication strategy? Sometimes you can perfectly do that, but sometimes it involves some risks. And there are lots of kind of mishaps with derivatives where this replication strategy didn't work out as intended. The biggest case was actually a German company called Metallgesellschaft. They were selling oil contracts, long-term oil contracts to their customers, saying you can buy from me oil for a fixed price for the next 10 years. Right, so that was the stream of cash flows they were selling. And then they said, okay, we don't actually want to have the risk of increasing oil prices, so let's replicate or hedge this. But the problem was that the financial instruments they had available were only short-term contracts. We're actually going to study this in a couple of weeks. Oil futures, which are short-term derivatives. So they basically had a short-term strategy in the market and a long-term commitment to their customers. That was a mismatch, and it went terribly wrong. They lost billions of euros. It was the biggest bankruptcy in German corporate history. Right? We can study this case later if you're interested in this. All right, so replication is basically the bread and butter business of investment banks. Right? And the big derivative departments, what Goldman Sachs and Morgan Stanley are doing. Right? They're only worried about how can I recreate something using other things. Right? So the big thing that caused the financial crisis, 2007, 2008, these were mortgage-backed securities, right? And you basically threw in a couple of mortgages into a portfolio, and then you sliced them into different financial instruments, right? So this is just an application of this. Sometimes people call this financial engineering, kind of to express that they're doing something technical here. But it's always the same pricing principle. And again, we're going to use the replication strategy whenever it's easier compared to using present values, right? So if you don't know what, for example, the discount rate is, just the problem that we had before, maybe we could easily do this using replication. Replication is something like a comparison approach, right? So even in the stock market, there's something like comparable company analysis, which is kind of an empirical version of this. So if you want to look at what's the value of BASF, you look at all chemical companies, like Bayer, Montpellier, and so on, like Sanofi, whatever chemical company you can come up with. And then you look at how are they kind of valued in the market. And then you learn from them, okay, I take the average valuation from those companies and apply that to BASF. That's basically the law of one price in the empirical version, right? You learn from the valuation of the other stocks, and you say, okay, now I use this and apply it on my target BASF. Right? So it's a very common pricing principle about comparisons, and can be applied in much more complicated settings. Now, maybe this is a good opportunity because it's, before we get into practice and application of this, kind of a judgment question. Do you actually believe that markets are free of arbitrage? So does that make sense for you? Is that a sensible kind of assumption, or am I selling something totally unrealistic to you?
I would say they're highly rare, but they exist. For example, sports betting, arbitrage. It's a financial market, but
Yeah, so that's actually a good point. So we're talking a lot about financial markets, but there are other markets that are, even commodity markets that I just mentioned, or sports bets is a good example, that are not kind of, where there's not so much trading, and kind of people are not so educated sometimes in these markets. An example about sports bets, I do have a friend who is a physics researcher, he's actually a professor, and he makes a lot of money on the side with sports bets. But he's never betting on a specific team, he's doing an arbitrage trade. So maybe give away his secret here, but so the thing that he observed was that, for example, if people watch a football game, say Bayern Munich is playing Dortmund, and so they see maybe their team is behind, say like the situation a couple of weeks ago, that Bayern is leading 2-0 with Dortmund, right? And then people see on TV that suddenly Dortmund is attacking, right? So what happens is people start in real time betting on Dortmund because they see that the game is working kind of into their favor. However, if you think about this rationally, what is happening to the probability of the team which is behind winning if the time in the game moves on? It actually decreases, right? The less time they have to catch up, the lower their probability.
The return is increasing. The return is increasing. Probable return, yeah, if you bet on
Yeah,
them.
so what actually happens is that the likelihood of the team which is behind winning goes down, but the betting is different. People start betting on this in real time, and it's not rational to do this, and you can actually do an arbitrage trade based on this, because most of the time, what he does, he's betting against kind of private individuals, and then he's kind of doing a hedge bet on the other side with kind of bet and win, and he's so successful with this that they offered him to work for them as a bookie, which he doesn't. So he's put up a computer doing this automatically. I think it's in London, and he does a 6-digit number per year with this. Right?